thanks for joining. We're very happy to have you here to talk with you and bring some light into employee participation plans in Switzerland, together with Karim of Kellerhals Carrard and then me from Ledgy. And probably most of you have already worked with Ledgy or with Kellerhals Carrard, and we're here today to, again, present quickly how these templates work, how you work with Ledgy to manage employee participation plans, and then a presentation by Karim about some core decisions that need to be taken to set up such a plan, which is more or less half an hour. And then the second half hour, 20 minutes to half an hour, is question answers by you. We have some questions already we got beforehand from you, and then you're welcome to add some more questions in the question answer feature. At the bottom of the screen, you should see a Q&A or F&A for Frage and Antwort, where you can just write your question and we'll pick it up at the end.
Sounds like a plan.
Great. Okay, I would say we start. I will now show you how you can access the templates in Ledgy, what to do with them, and then when you set up your plan, when you have set it up, how to manage it. So for this, I will share my screen. Give me a second. So now you should see the document page on Ledgy. Is that correct? Here, when you sign up on Ledgy, create a company, then you can head to the Documents tab, and here you can click on the Legal Template button at the top right corner, and there you see the guides to download. I'll open the chat. Nadia, let me quickly introduce Nadia, who is moderating. She's also here at our table and helps us to manage this webinar. Thank you very much. So here you see the employee participation plan templates with a short description. I will come back to this guide later. You download the guide which you decided, the template you decided, either stock or phantom, and then you will have these Word documents, which are high-quality templates developed by Kellerhals Carrard, which they use for their startups already on a large scale, and which they now provide for free for you to learn how they are to be better prepared if you go to Kellerhals Carrard with this plan, or to maybe even do it yourself. And the things that are marked in yellow are the things that have to be adjusted. Most are simple things like company name, date, and so on. Then there are several fairly standard clauses which can be used as is. And then there are some things you really have to decide and adjust in the template. And for this, the guides help you. I will show it to you here. So these guides, one for stock options and one for phantom plans, tell you the main parameters, which is 5 to 10 parameters. For example, how many options to reserve for the employee participation plan. It helps you to understand what it's about and give you common practices to decide, to help you decide what to do. After doing all this, you have to approve this plan with your board, with your investors. That's important. They always have a say in this. And then you're good to go. Then you can give out your first grants to employees. And now I will show you how to do that in Ledgy. So let me quickly share that with you. So now we're back in Ledgy with where you download the guides before, the templates before. Maybe a quick word for those who haven't worked with Ledgy. It's a platform for investors and their startups for managing financing rounds, managing employee participation plans, vesting plans, and also investor relations. And it's especially good for preparing us for future due diligences. By setting it up well at the beginning, it helps you to save a lot of issues and time and money later on in the later rounds. So after we have decided how many options we want to reserve for employees, you have Okay, it's important to note that tracking the vesting plans and the options themselves is a premium feature for which you have to take the premium package, but you can already on the transaction page add a pool of for the ESOP plan, which we just decided. So let's say it's 100,000 reserved options, which will convert to common shares if they are exercised. And you can also attach the employee participation plan document for future reference here. Then in the premium plan, you have the incentive page where you can easily track vesting and also how much you already used of your pool to always have the overview. And it also helps you by sending you updates. So when the vesting ends or the cliff is reached, it will send you an email notification so you know that you should sit together with your employee and talk about the next steps or congratulate. So it's very important also to use these grants also for what they are to motivate employees. So after we have added this pool, you can give out options from this pool. So you do this by clicking on Add Incentive. You choose our ESOP pool, which you just created, the person you want to give it to, for example, him, 20,000 options, a strike price if you have one, which is the usual case, and also expiration if it has. Very important, of course, most have a vesting schedule, so you would add a vesting. You can choose a vesting which you already defined before. For example, this one, 48 months, it's 4 years with a monthly vesting at a cliff of 6 years, which you see also in this graph. But of course, you can also define a custom vesting, for example, this one where it's backloaded goes up towards the end, which is also sometimes used. As I said before, you would usually attach the relevant documents. Just for an example, I can do it like this. I add it, and then I see this new option appearing here. I also see how much is already vested for this person and for the individual grant, in this case, none. For this older option, there are already some vested. Now, I'm almost done here. What is important also is after options are vested, they can be exercised to shares. So you can do that on Ledgy to properly track how many are really still outstanding, how many are exercised. And you can also terminate options when the employee leave the company. So you would always have the correct numbers here in Ledgy. And we have already seen several cases where this is not properly tracked, and several years later, there are big issues about that coming up in financing rounds, and investors are very picky about that. So now that we have this, two more details on the cap table. You can select fully diluted view, where also this ESOP, which is still open, which can still be given to employees, is added, and also the options we just gave to this person, for example. And then on the stakeholders page, you can also invite your employees to give them access to their own stake, not the full cap table, but just what they own, this portfolio access. By clicking on invite, sends an email to them, and they can sign up and see in their account how much they own and how much is already invested. All right, so much from my part. I will quickly check my notes, but I think this is mostly it. So I hope it's a bit clear for you now how you can use Ledgy to have a proper housekeeping, which is really important to do that from the beginning. As I said, for due diligence in the future, you can also give view rights for lawyers or for future investors to check all the transactions, to check the pool, the documents, and everything concerned about this. And this will help you during financing rounds, besides all the other features like round modeling and investor relations, which you also have. And with this, I would give to Karim, who will now present to you some more in-depth details about these decisions you can take to set up a plan.
Very good. Thank you very much, Ben. Hello, everybody. My name is Karim. I'm a partner and head of the startup desk at Kellerhals Carrard. In that capacity, we've been lucky and privileged enough to advise many startups, in particular on the question of ESOPs and PSOPs and whatever terminology is out there. And just to make a very quick introduction statement, which was not really aligned with Ben, but I really want to say how enthusiastic I am about this initiative that you started, Ben. Already with the cap table, I thought that this was really addressing a big need in the startup ecosystem, and now you're taking it a step further with this ESOP capabilities. And when Ben initially reached out and asked us whether we would be up for contributing content for that initiative, it was a no-brainer for us to support this initiative, because as you can imagine, and that's also the reason why you're probably participating in this webinar, sooner or later you will come across ESOPs and PSOPs in your startup. So there will be the moment when you will have to decide how to incentivize your future hires or your current hires. And then you have the question on the table, what's the best thing for you to use? And accordingly, we have many discussions, many workshops with founders on the question what they should implement, how they should implement it, which questions they need to ask, etc. And I think given that it is such a broad need within the startup ecosystem, every step that makes this topic more accessible and more easy to understand is warranted, which is why we're totally standing behind this Ledgy initiative together with our partners Wenger-Feely and Lexar, who helped us review the templates that we ultimately drafted for this purpose. So having said that, just as a quick introduction, I wanted to take a couple of moments to share with you some of the main considerations when you set out to decide on a plan for your own startup. And I will quickly guide you through the slides which we prepared. I'm not going to spend time on every slide, but it's of course available for everyone who wants to take a closer look. Just drop us an email if you don't have it, and then we'll be happy to share it. So maybe first and upfront, the question, what actually is an ESOP or a PSOP? Because there is so much terminology out there, and sometimes it can be confusing what people are talking about. And I think the important thing to note there is not really a 100% clear terminology out there. So don't be confused with the abbreviations. At the end of the day, you need to understand the instruments that you would consider for your startup and then implement it in the right way. However, ESOP is probably a word you have heard many times. Traditionally, it stood for employee share ownership plans or programs, and then somehow moved into employee stock option plans, which was more specifically speaking about a certain instrument rather than a general description. Whereas the PSOP is a rather recent invention, if you want, in the terminology. And it's owed to the fact that in the past years, there has been a surge in the use of virtual participation programs. So instead of giving out real equity, people reverted to virtual shares in the company, and they were labeled phantom shares or phantom stock options, which helps explain why there is this terminology out there with the PSOP. But at the end of the day, don't be confused. As I said, it's more important to understand what is behind these concepts. And on the slides that you see, we start with the ESOP in the sense of an employee stock option plan. So the question is, what is an option? And probably this is known to most of you, if not all of you, but an option is simply a right to acquire shares in the future at a predetermined price. So you don't have to acquire shares, but you can acquire shares, which also means that you don't get shares right from the start. It's just a right that you can exercise if you feel that you want to exercise it. That is the difference to a share, which we will cover in a second, as opposed to a phantom stock option or a phantom stock, where people would not get any entitlements to shares, so they will never ever become a shareholder if you implement a phantom plan of any kind. Here, it's really all about the idea to put the employees in the situation, synthetically if you want, in which they would be if they were shareholders. So bottom line is, in a virtual program, you want to make sure that from a monetary perspective, people are treated as if they were shareholders. That's the main difference between the two. I already mentioned it, shares would also be an option or a possibility rather to avoid further confusion to give to employees. Now, some startups actually use that as an instrument. So some startups give out shares to employees, which offers some actually some very nice tax optimization possibilities. But one of the main reasons why you don't see that very often out there in the ecosystem is because the minute you grant shares, you trigger income taxes on the part of the employee. We'll cover this also a bit more in detail in a moment, but this is the main reason why the grant of shares is not so much used in Switzerland. If you grant options instead, then people are not taxed right away, which obviously is more beneficial for most of them because many of them don't want to pay taxes on something of which they don't know whether it's ever going to materialize in terms of value. And ultimately, just to complete the picture, what is a bonus plan? Well, you may know that or heard about that from more traditional companies. Mostly it's used in the sales departments where you try to incentivize people. Among startups, it's very rarely seen, at least in the early stage area. It's rarely seen because you try to save liquidity, which is why you don't really use bonus plans. I'll skip this here in order to save time. Now, to some pressing questions which usually come up. What is most commonly used in Swiss startups? I already gave you a hint that share plans are not so widely used, so it boils down to option plans and virtual plans. And here it depends very much on who you talk to. Some people will tell you, don't ever touch a phantom plan, whereas others will tell you, why are you still considering an option plan if virtual plans are available? So it's kind of a philosophy question to some extent. I can at least tell you from our perspective, and this is pretty much aligned also with our partner law firms that helped us review, you see a broad diversity between option plans and phantom plans. So in our own law firm, we typically have a 50-50 split between startups choosing an option plan and startups using a virtual plan. And mainly, it's really all about the tax implications that are associated with these two programs, which gives the decision what to use. Because, just to make the statement already at this point, if you choose a virtual plan, a phantom plan, or whatever you want to call it, we are not talking about any kind of tax optimization. There is no such thing as tax optimization if you use a virtual plan. Whenever the employee gets cash out of the plan, it will be fully taxable and fully subject to Social Security. So it's treated just as salary. This is not a bad thing, but if you revert to options instead, then you give people the opportunity to optimize their taxes to some extent. I'll cover that in a moment, but this is one of the differences between the two plans. And ultimately, of course, it's really all about you and your own decision what your company culture should be. Because because some startups or some founders say, I really want to make sure that people feel part of the family. I want to make sure that they can become shareholders in the company, which is why it's a no-brainer to me to grant options and not something like a virtual plan. Whereas other founders say, hey, this is not so important because they will hold a minority stake anyway. So this is not a decisive thing. I just want to make sure that they get a decent monetary claim if the company exits. And then they revert to virtual plans. So at the end of the day, it's not only legal and tax considerations that play a role, it's also a question of culture, which only you at the end of the day can decide what is best for you. Very quickly, a few pros and cons. If you look at an option plan, I can't stress it enough that this is internationally the most accepted means of incentivizing employees in a startup. So regardless of what type of investor you will be speaking to in your next funding round, if you tell them that you have an option plan in place, no eyebrows will be raised. People will understand what you have, it's all good. It's also easy to calculate the dilutive effects. It's easy to reflect it on the cap table, which is managed by Ledgy, etc. So it has a clear advantage in that sense. Plus, it offers a certain tax optimization in certain circumstances. However, there are also drawbacks. So if you put yourselves into the shoes of an employee who wants to avoid taxes unless he knows, that the company will do fine and he will ultimately benefit from an exit, you would typically hesitate to exercise an option. And you would typically wait until the exit comes nearer and nearer and nearer. And right before the exit, you would exercise your option and cash out, which is all fine. However, it doesn't offer a tax optimization in that sense. And if that is the case, then you can ask the question, well, how much benefits are really associated with an ESOP, and why don't I directly go to a virtual plan, which is ultimately the same thing, it's just cash settled. So this might be one of the considerations which might speak against an option plan. Plus, handling an option plan can be more complex. So there is more admin involved because you need to make sure that shares are made available. You need to make sure that if people exercise, that you update your articles of association. You need to go to see a notary. You're pretty likely to have a need for a tax ruling, which needs to be worked out and which will cost some bucks. So we definitely have a complex instrument with an option, but it's still a commodity. So it's not something which is totally out of the ordinary. It's actually a very common thing, but you need to know that it's that it offers some administrative burdens that come with it. If we look at the virtual plan instead and ask the question, what is favorable or speaking in favor of those plans, then it's just the fact that I mentioned many people would simply wait with exercising options until the exit. In which case they don't ever benefit from being a shareholder because they sell their shares right away in the exit anyway. So you can say, why bother with an option plan? Let's simply do a virtual plan. Plus, you don't have any tricky tax implications that you have to think of. As I mentioned, it's just as salary, so no tax ruling necessary, no tax optimization questions on the table. It's straightforward, not tax optimized, but straightforward. And it's less complex and costly to set it up. But here, a little caveat from my side, don't underestimate the management of the virtual plan, especially when it comes to an exit, which is also a reason which might speak against such a plan. Calculating the exact cash amounts in an exit scenario under a virtual plan can be a tricky thing. Now, this doesn't sound very understandable at first sight, but if you dig a bit deeper into the plan and the considerations that you will have to make work within that plan, you will see that there are some complexities that can complicate the calculations, which might be a drawback as opposed to an option plan. There are also drawbacks. I just pick out a few selected ones here. One is a virtual plan is ultimately nothing else but a plan to pay cash to employees under certain conditions. And those of you who are familiar with accounting, they will know, oh, this is a liability on your balance sheet at some point. So this has a balance sheet impact, accounting for the virtual options that you grant, which is not the case if you use share options. Plus, virtual plans need to be checked from country to country. And so we just recently made the experience with France, where we tried to roll out a virtual plan from a Swiss startup, and it was very clear that we couldn't do that because the tax treatment was so horrible in France that we had to revert to an equity-based incentive plan for the French employees. This would not be an issue so much if you have options, but with virtual plans, you really need to do a check from country to country in order to be sure that it really works. I will skip this slide, already talked about it. Maybe a quick word here on when to create an incentive plan. It's interesting because many startups that are in the incorporation phase and already thinking ahead of their upcoming financing round, they would tell us, yeah, and by the way, we also need an option plan in place for our employees, which is typically premature. So typically you first need to close a round in order to hire people, and only then you will have to be in a position where you can grant some kind of incentives. So typically people implement employee participation plans after a first round, and it's probably also a general recommendation that I would have for very early stage startups. Don't bother too much if you can, and rather try to keep your employees with you until you close the next round, and you can give them a letter of intent that you grant them, that you consider them when you set up the plan. But getting to work with the plan too early can absorb resources which you rather might want to spend on bringing the case generally forward. So this is maybe a little bit to tell you, don't over-engineer too early when it comes to ESOPs. But as soon as you have funding, then you typically grow and you need people, and then it makes absolutely sense to roll out a plan. Here in the slide, you find some additional considerations which you can take a closer look at later. Now, I already mentioned it, the questions of which plan is the right one and what are the pros and cons of each plan. Ultimately, we are always talking about tax implications to a large degree, which is why I don't want to go into all the details here, but I want to give you the basic rules to take away. Let's start with something which is not common, and I will tell you afterwards why I start with that. But let's look at the grant of shares to employees. Let's assume you grant shares today to your employees. This creates, as of today, a taxable event on the part of the employee. And if the employee gets shares today, then of course the question is, what's the value of those shares that he's granted? Because if he's taxed on it, then the question is very relevant, what's the value of the share? Now, tax authorities, they would typically revert to the fair market value of a share, which in the worst case for you would be a recent financing round where you try to increase your valuation. But if you then told employees that they would be taxed on that basis, then your employees would probably run from your startup because the tax bill would simply be too high. Luckily enough, in the canton of Zurich, there is a regime now in place which says that as long as you qualify as a startup for tax purposes, which means that you need to satisfy certain criteria, the tax authorities would not look at financing round valuations for income tax purposes. They would rather revert to the net asset value of your company, but that comes at a price. So tax authorities offer actually a way to pay lower taxes, in which case, however, they will typically tax again when the employee later sells the shares. So this is the price that you would pay if you benefit from a lower taxation at the point of grant. Now, one thing to consider, and this is actually one of the beauties that you find in Swiss tax laws, is if you have shares and you sell them, then typically the money that you get for those shares is a tax-free capital gain. That's one of the beauties in Switzerland. It's everything but for granted. But in this context of employee participations, in the startup context, this is thwarted by what I just explained. That is, if employees in a startup benefit from a lower taxation at the time of grant, they will not be able to realize a full tax-free capital gain, at least in most cases not, because the tax authorities will come again and tax you at the time of sale. There are exceptions to what I said, but the principle is you get shares today, you're taxed today, and if you're tax privileged, you will be taxed again when you sell the shares. This is different if you look at the tax implications of options, because if you grant options today to your employees, tax-wise, nothing happens. And that's the great thing about options. However, the minute employees decide to exercise options, there will be a taxable event. And it's again the same principles that apply that I just explained with regard to a share grant if you exercise an option. Because if you exercise an option, you get shares, you become a shareholder. So we again have the question on the table, what's the value of the shares that you get for tax purposes? Now these questions, whether it's a share plan that you have or whether it's an option plan that you have, the question of what the tax implications are and the question of how much tax optimization you can put to use is a question that is ultimately answered in a tax ruling. And the tax ruling is ultimately a letter that your law firm or tax advisor sets up, aligns it with the tax authorities until they put a stamp under it, and then you have, so to speak, a deal with the tax authorities. This is one of the great advantages in Switzerland, because in other countries such tax rulings are not available. And this helps you creating certainty for your employees, but also for you as a company when it comes to the tax implications. Plus, you can offer some tax optimizations for the employees, which might be an attractive thing. All of this, however, is not relevant if you grant virtual shares or virtual options, because then, as we said, the minute cash flows, there will be a taxable event with no tax optimization possible. So these are the main considerations and main implications of incentives plans. In our slides, we have a couple of more considerations that are interesting. I will mention just one more slide and then wrap it up in order to allow for questions. But one of the questions that we often get is, well, how big should the ESOP be? How big should the pool be? And how much should I grant to individual people? Now, it goes without saying, this is, of course, very different from startup to startup. There is no such thing as a general benchmark that you can use. However, if you look at it from an investor's perspective, investors would typically expect to see 10 to 20% across the board reserved for employees. This is just a piece of experience and something that reverberates from financing round to financing round. It's something you will stumble over sooner or later for sure. However, how you structure it and how you allocate it over time is again a very individual thing. Generally speaking, however, the 10 to 20% is probably what you would ultimately have to expect as a request from investors, but it may also be your own intention to set aside such a size. On the individual level, I can't stress enough that the numbers that we have here in the slides is just an indication. It can differ very, very much from startup to startup and from person to person, but these numbers just aim to give you some kind of indication of what we often see in the market. So generally speaking, you should, of course, be reluctant in granting too big of stakes unless you have good reasons for it. And hopefully these figures can help you to put it a bit into perspective. With that, I would close. Obviously, we are available for further questions. We also received some questions up front. Shall we tackle these right away?
I would say that's a good idea. Thanks for the presentation. Very insightful, and also from my side, I didn't really stress it before so much. It's really great to work together with you and to see how enthusiastic you are about these digital solutions to your work. And I think they complement each other very well. All right, so I would say let's take the second question first, which we got before, because you already discussed it. How much equity can a company reserve for employees? You already mentioned that. Maybe you can say one or two more words about, do you reserve this full amount from the beginning, or is it increased over time? I think that's a question that often comes up. And also, for individual people, do you give everything once, which vests over a long time, or do you give grants several times to stock it up?
Yeah. Yeah. So let me quickly start with a technical answer, because I don't know if the person is on the webinar that posed the question. But the question hints to me a bit to the question, how much equity can the company hold for ESOP purposes? And the technical answer to that would be not more than 10%. But this only applies if you have treasury shares, meaning shares on the balance sheet of the company, meaning founders or other shareholders contributed shares to the company so that they can be used for ESOP purposes. And the technical answer would be not more than 10%. But the broader question is, what's the typical size and how does it build up over time? And then it's the 10 to 20% that we see most often. However, from a founder's perspective, and this is a tip that I can share with you if you're still ahead of your first financing round, if you say for your own purposes the 20% sounds like a good number, you're actually convinced that this should be the right size for you from a company perspective, it may not be the smartest thing to reflect that already from the start in your term sheet that you try to negotiate with investors. because many investors will typically invest on a fully diluted basis, meaning that the example of 20% ESOP would be looked at as if they were created and funded solely by the founders and not by the investors that joined around, which means that the share price will be reduced by the 20% effect of the ESOP, and therefore give more shares to the investors that participate in your financing round, and therefore dilute you more. So as a tip for founders, our recommendation is typically to ask the question, how much equity do you need for the runway that the financing round provides? Because during that runway, you will hire some people, and you don't need 20% for the next 3 or 4 people that you will hire. So try to shrink down that number to a certain degree in order to avoid that too much dilution is shifted over onto your shoulders. So in order to answer your question, Ben, I would generally say it's built up over time because you don't want to bear the dilutive effects on the founder side upfront exclusively.
Makes sense.
And then it's of course a matter of negotiation with the investors.
Yeah. So I think you already answered this question by Romeo. Are the shares in the pool considered as held by the company? What is the legal limit of shares that can be held by the company? That you said already 10%. Then I think that I shuffle a little bit the questions around so they fit from the topic. So the other question here is, okay, you want to create a pool. There are different options, different possibilities to create a pool. You can have shares reserved, you can have conditional capital, or you can have authorized capital increase. So maybe you can say what is the best approach here, the most cost-effective way for a small company.
Absolutely. So if you have treasury shares, then of course it's an easy way to implement it, because then you just give out the shares when options are exercised. It's a very simple process in that sense. However, it's rarely the case that people contribute shares to the balance sheet of the company. Not least because this always triggers a stamp duty of 1%, which is payable by the company. So typically this is avoided at a very early stage. What we see clearly most often is the use of conditional share capital. Now I'm strictly talking about employee options and not anything else. There we use conditional share capital most often because once you created it, it's there. You don't have to renew it. You can simply use it to fund an ESOP plan. And it's another question of how much you are actually going to use it specifically for grants to employees. So the conditional share capital is the tool that is most commonly used. It does have some administrative disadvantages, unfortunately, because once per year you need to update the conditional share capital, which means that you need to go to see a notary to update the articles. So that's the only drawback.
If you exercise options, then you have to go to notary to update that there were new shares created. Is that
only once a year? So when people can, throughout the year, they can exercise as many as they want, and then once per year you need to update it.
Okay, so what about the other, so transferring from the founders to the treasury or reserve founder shares? That's more for a share plan, or is it also used for option plans?
It can be used for both purposes, so for share plans as well as for option plans, and you can do it exactly in the 2 ways that you just hinted to. One way is that the founders continue to hold the shares, actually, but in the shareholders agreement, they enter an undertaking based on which they make available the shares as and when needed for the employee participation. So, for example, if you grant options, options are not exercised for a certain period of time, then the founders could continue to hold on to their shares, and only when the options is exercised, the founders would have to contribute the relevant number of shares.
But still, conditional capital is mostly used.
It's mostly used, absolutely. Yeah. It also has psychological effects, because transferring from your own stake shares to the company, paying stamp duty for it, and then having to retransfer to the employees is different from just issuing new shares.
Makes sense. Okay. So I hope, Umberto, that answered your questions. If not, maybe you can specify again in more detail or which ones are still open. Another question that came up is concerning Ledgy, the management on Ledgy. Someone asked if Ledgy can also calculate tax and social security contributions, pay that exercise. That's not possible at the moment. Our software is also used by many startups in other countries, so it doesn't go too deep into the tax implications yet. Might come in the future, but at the moment that's not possible. Then another question was implications for tax ruling in Switzerland and Germany. What are the alternatives? What are lessons learned? And what are things not to do? Maybe I can hand over to you. It's a quite broad question. Maybe from your experience, are there some things that stand out which are good to consider?
So to clarify, tax ruling is a Swiss instrument. So you submit a tax ruling to typically the cantonal tax authority of where your startup is registered, and nothing else. And then you get certainty from that tax authority with respect to taxes in Switzerland, generally speaking. There are very little exceptions to that, but that's the general principle. And that means that a tax ruling, of course, doesn't have any kind of effect in other countries. And so you will have to look at the tax implications from country to country. However, it's pretty straightforward in most cases. So if you have a virtual plan in place, for example, the fact that taxation only kicks in when the employee actually receives money is the principle that you would see in almost all relevant countries. So far, we haven't seen jurisdictions where the tax treatment would already kick in by granting a virtual option to an employee. I'm not aware of that, not excluded, but I haven't seen it. So generally this works, but it's more a question of whether the tax burden that you have in specific countries are too prohibitive or not. And the piece of experience that I can share is with France, where virtual plans are really not favorably treated from a tax perspective. But other than that, it's very well doable. And one additional point to note for all those of you who are expanding into the US, this requires a separate assessment because in the US you have very specific tax regulations in place which necessitates a number of tweaks to your plans that you have here in Switzerland. But this requires a more in-depth analysis.
Okay, interesting. And Julie asked, because you showed the slide with the size of the pool and how much is a typical number for different types of people, for example, an engineer, where you stated 1 to 2%. So one question here is that 1 or 2% from the pool or 1 or 2% of the company?
No, so it's from the company ultimately that you would, that's how we meant the figures, not of the pool. But as I said, it needs to be looked at very individually from case to case.
Mm. And maybe to come back, because I'm personally also interested in that, do you typically see more often grants which might grant 1 or 2% at the beginning when you hire someone, or is it split into several grants over several years?
So that's a good question. You asked it at the beginning and I skipped it then. So the question is, how do companies typically go about with the granting? Mm-hmm. And there are two things that I can share here from my own observation of the startups. And one is, it's typically the approach where people look at a specific employee, ask themselves first, what would be the market salary of that person? Then ask the question, what am I actually paying that person for in real cash, which is typically, of course, less. And then you try to address the gap between the actual salary and the market-based salary with the equity incentive. And you would typically do this not only on a yearly basis, but you would do it over a vesting period, which is typically between 3 and 5 years. So you would do a full grant over the period of 3 to 4 years or 5 years, whatever is applicable, because the vesting takes care of the situation when he leaves or when he or she leaves early. So that is one way of addressing the question, how much should you actually allocate? But that's only one consideration to look at. The second consideration is that regardless of what the gap is, you would want to see or have a proper understanding of what is the ultimate ceiling that a person should not exceed. Because you don't want just to grant if people ran out of equity incentives, so that people go on an individual basis too high in their stakes. So it's like, this would be the default approach with the market-based salary question. capped with a general understanding where you would say people should not exceed that. And then what happens in practice is that on a yearly basis, you look at the grant that you did last year. That's if we look at it from the start, we would grant today based on the valuation that we think is applicable today to address the gap. A year later, we would check whether the valuation is still more or less accurate. Does it still make sense? If yes, then there is typically no need to do anything. If the valuation went down, then you might have to consider an additional grant in order to keep the employee incentivized. Or if other considerations apply, you might also do a grant just to increase the incentive. But then the point is that it's typically reviewed on a yearly basis whether the equity incentives that you granted still work. So it's not a yearly grant that you would typically do. It's rather a one-off approach with a yearly check whether it still works.
Makes sense. And then maybe after 3 to 5 years, you might think again about a second grant for the next period if necessary. If the employee is still there and the company is still going strong.
Exactly.
Another question is from Manuel, if it's possible to switch between different schemes. So for example, give shares to the first few employees and then set up an ESOP or a PSOP and switch between one to the other, and if this is recommended.
That's a very good question. Thank you, Manuel, for that. So let me try to answer it this way. We see many situations where the founding team, after the incorporation, expands the founder team with a late co-founder. So technically that late co-founder will be an employee, but he has the quality of a co-founder. In which case we typically consider the question, wouldn't it make sense to make him a shareholder right from the start rather than give him just options? It's also related to the question that a co-founder should have a decent high stake from the beginning. So in those cases, we would typically look at the situation to grant shares to tackle the tax implications accordingly, which can typically be addressed in the current environment, but then recommend not to use further share grants for additional employees, but rather implement an option plan or a virtual plan for every other employee that then follows. Whether I would recommend to grant shares to initial employees generally, even if they don't have founder or late co-founder quality, there my recommendation is to say no. And the reason why I say no is because if you grant shares and you have to address the situation where people leave early, there is an administrative hassle involved, which is not always easy to resolve. So you need to get back the shares. So that means you have to take corporate actions, signing papers, board resolutions, etc., amending the share register. Technically, typically doable, but it's a hassle. And so with options, it's much, much easier because if people leave, then options lapse, and those that are vested, they can be kept, but you have much less administrative burden.
It's just a contract which is more easy to handle.
Absolutely.
That actually goes very well into the next question about how much, what happens to shares that have not been fully vested? Do they go back to the company, or where do these unvested shares go? So as you said, when it's really shares that were granted, you already transferred the shares, so it's a bit more difficult. When you have options, you can just terminate them. It's in the contract, it says what the conditions are. And you can talk a little bit more about what is typically done. Are vested shares kept? Unvested shares, they go back to the company, and where do they go exactly? Talk a bit about this.
So I think there is a quick fix to that, or a quick answer to that. Regardless of what instrument you use, whatever is unvested remains available for a regrant. So let's look at options, for example. Unvested options, they lapse when people leave early, which means they evaporate, which also means that this respective number of options you can reuse by granting it to another employee.
So it goes back to the pool.
It goes back to the pool, and the same in principle applies if you have shares. In the rare case where you would have shares, but the same would apply because the shares go back to the company, and then you can just simply use it for an additional grant. So generally speaking, unvested parts go back into the pool and are ready for reuse.
Okay, I think for the moment, very interesting. I'm also still learning more details.
So am I.
for the moment, I think we answered all of the questions, and we have 12:25. So I would say you have a last chance to ask another 1 or 2 questions, which you can address here. And if no other questions come up, then I think we're good to go into lunch break. So last chance for you. Do you have any more questions? Just post them into the chat or into the question answer tab, and we can address them. Otherwise, I think we covered already many topics, many details, and answered all the questions. Okay, I think then, thank you all for attending. Thank you very much, Karim, for working together with you. It's a great pleasure, and let's push the startup ecosystem in Switzerland and make it much more easy for startups to give shares to employees and therefore make them also more successful themselves.
Nothing to add. Nothing to add. Thank you very much.
Have a great day. Bye-bye.
Thank you. Bye-bye.